Yeah. Good afternoon, dear students. Welcome to Insights into Audit, Bridging Theory with Practice, right? And we have completed our preliminary engagement activities and session on audit strategy, audit planning, and audit program. Now the turn comes of risk assessment and internal control. Right? As you are aware that audit is backbone. Auditing is not just about finding errors. It's about finding solution also. So we need to analyze, we need to assess the risk. And today's topic is also risk assessment and internal control evaluation. And we are having a learned faculty with us. He is CA Roshan Bajaj. He is co-founder and director, having 19 plus years of professional experience in audit, assurance, risk management, and management consulting. He was in Big Four professional. He is also having vast experience and exposure to large scale audits and consulting assignments. He is also having expertise across diverse sectors like telecom, IT, FMCG, infrastructure, BFSI, automobile, and manufacturing. Apart from CA degree, he is also certified in IFRS and Forensic Accounting FAFD. He is also member of the Research Committee on Auditing Standards for LLP. He is regular faculty for C&AG training program and a recognized speaker at National Industry Forum also. He is also known for driving process transformative transformation system design and operational excellence across engagements, right? So I hope you all are enjoying the session because we at Board of Studies Academics trying to make you have experience like what is when we interlink the theoretical knowledge with practical one, right? That is the reason we have kept the title Insight into Audit or Audit Insights, Bridging Theory with Practice. So I hope when you are understanding the practical implication, you are correlating the same with standards on auditing, engagement and quality control standard for better understanding. So not taking much of the time because we are having a learned speaker with us. So not taking much of the time, over to you, Roshan sir, for the session on risk assessment and internal control evaluation. Thank you.
Thank you very much, Karuna ji, for setting the tone for this session. First of all, I would like to congratulate Board of Studies for coming up with this kind of initiative where students from CA Inter and Final, they are getting this opportunity to basically understand what exactly happens in the audit world. We keep on hearing, we keep on studying audit, we keep on hearing about it, we read a lot of things on media also. So but after all, what we need to do as students when we qualify after our CA inter and finals, then we need to conduct audits. Definitely many people can go to other profession, but this is something which is our bread and butter for most of the most of the CA professionals, right? So this is actually a wonderful initiative which has been taken by ICAI Board of Studies. And thank you, Board of Studies, for inviting me for this session. Generally, I'm really happy to interact with students because this is something, this is the journey which we also have come through, and that was a highly entertaining and enthusiastic journey even for us also. So a lot of positives and lot of such things that make you feel like whether I'm going in the right direction or not, what kind of road I have to trudge in future, so which particular aspect I need to get into. So all those things keeps on coming in the heads of the students while they are studying, right? So the topic which has been allotted to me today is risk assessment and internal control evaluation. But before getting into the nitty gritties of the topic itself, first I would like to set the tone for this session by creating a foundation. uh, what happens many when even I was studying, and even while I'm a professional, Then also many people who are layman from basically this profession, who don't have much idea about this profession, they keep on asking what is audit, and explaining them what we do in audit. That is actually a Herculean task. It's not very easy to make them understand what exactly we do in audit. So these days, definitely a lot of auditors, lot of audit aspects have come in media, and we are all through, and most of the people are somewhere invested in stock markets also. So they get some idea about what auditors do, but still explaining a layman what is audit is very difficult. But since all these students are from our profession, so I take the liberty to assume that at least we know what is audit, right? So from that perspective, I'll be taking over this session. uh, See, what over 19 years of my experience as an audit professional, and if you add up 3 years of articleship, earlier it was 3 years. So in total, I have been in this profession for 22 years. So in these 22 years, what I have felt, that what actually audit is, that is majorly having technical knowledge is must. There is no doubt that we need to apply the theory. Whatever we learn in theory, that needs to be applied in practicals. Plus, it needs a lot of common sense. Audit is more about common sense. Definitely, technical knowledge, most of the people have who are in this profession. Everyone has the technical knowledge, they have all the theoretical database with them. But having common sense, that is quite uncommon these days, though we call it common sense, but that is quite uncommon. If many a times I have seen people who are working with us as interns, articles. So when I talk to them, even though they are very very bright minds, but when it comes to audit, many a times what they do, they go into looking at micro picture rather than macro picture of anything. So broad understanding they are not having, they are just getting into the nitty-gritties of anything, and then making wrong presumptions and going ahead with that presumption. So definitely whatever I'm saying now, it must be, you must be feeling that this is not actually getting into our heads properly. But let me assure each one of you that when we go in the course of this session, I will give you a lot of insights, and you will get lot of learning from this session. Be rest assured about it. So uh, since the topic which has been allotted to me is risk assessment and internal control evaluation, so first of all we would need to understand what is risk, right? When we are talking risk in the context of audit, what do we mean by risk? By the way, risk in the common parlance, even in our daily life, we keep on facing a lot of risk. Like, for example, if we are riding a bike, it also carries a lot of risk of accident. Even though I may not be at fault, but someone else may commit that fault, and even that may harm me, right? So even take an example of a marriage. So marriage is a big decision to take, right? So in case of marriage also, say for example a girl is about to marry a boy, so a lot of risks are associated in a marriage also. What kind of risk? Like, ladka kaisa hoga, how will be the boy, whether he is earning properly or not, right? Maybe we will also look into the family they belong from. How is the family, who are the members, in how big is the family, whether the boy is living in the joint family, or he is working he will be living in a nuclear family. So basically a lot of questions comes into our mind even taking that decision, and it carries a lot of risk. But to mitigate that risk, even what we do in case of the first example, when we ride a bike, we take a formal training of driving, of riding a bike before actually getting into it, right? A formal training is required. For that you would need a driving license also. So that is again a control. right? So risk is that we may commit an accident by riding a bike, but a corresponding control is that you have to undergo the compulsory training and acquire a driving license, right? Apart from that, maybe we may face losses in case of an accident. Maybe it may be a self loss or a third party loss. So for that, we need to take insurance also. So that is again a control which has been subjected by the authorities, that you need to take insurance. That is compulsory. Similarly, in case of the second example also, in case of marriage, we do lot of background checks, we do lot of reference checks, we uh, get acquaintances from the organization the person is working with, we take information from them, we try to get as much information as possible, because that is a decision which is a very very big decision for life, right? Similarly, when it comes to risk in the context of audit, so every risk should have a corresponding control. This is the baseline. Every risk should have a corresponding control. I'll be sharing the slides, but I'm just creating a background now. I will definitely share the slides. So every risk has to have the corresponding control. Ankita, you intend to say anything?
No, sir.
Perfectly
You may
fine. Okay.
continue. Yeah,
Okay.
yeah.
Okay. I thought she wants to say something. Okay, no problem.
No, 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 no. Yeah.
Okay, okay. So basically, every risk has to have a corresponding control. When we talk about risk here, what risk we refer to? We are referring to risk of material misstatement. What we are referring to? We are referring to risk of material misstatement. So anyone amongst you has an idea what we mean by risk of material misstatement? Can you just drop your comments in your chat box? I want to see few comments. What do we mean by risk of material misstatement? Anyone? So I'm not getting any responses. So,
Checking,
Karunaji, I
sir.
hope
One
that they
second.
will be able to post responses.
Yeah, yeah. We're just checking that one.
Okay, okay. Because I did not get even one response. Because I just want to make this session as interactive as possible. Definitely, virtual sessions are not that interactive. It's a one-way communication mostly. But still, I want to try you guys also to engage with me to make it more interactive.
Right, sir. Right, sir. As and when we will receive query and feedback, we will
Okay.
share it to you. Yeah.
Okay, no problem. Perfectly fine. So I'll continue with it.
Yes,
So
sir. Yes, sir.
yeah. So risk assessment risk assessment carries identification of risk of material misstatements. Audit as such is a journey. It starts from the engagement acceptance. It goes till the archival of the audit files. It starts from the engagement acceptance. It ends at the audit file archival. So throughout this journey, at every step, we have to identify or we have to assess it for risk assessment. We have to assess the risk. Like I'll just open the slides now. It will give you a fair idea. Just hold on.
Is significant risk which students have answered. ROMM is significant risk which impact final decision.
Okay.
Another one is
Okay.
saying probability of financial statements being misstated materially.
Wonderful.
And
Right.
one has written IR multiplied by CR. IR multiplied by CR.
Okay. Formula he has
And
given. Okay. Great.
Risk
Great.
of happening material things, Sumit is writing.
Yes, yes.
Yeah.
So whatever
Actually, maybe
whatever
due to
comments we have received.
network issue, na, the answers we are receiving up is later on, actually, not
Okay, okay, okay. Got.
immediately.
Okay, okay. I
Yeah,
was not aware
yeah,
of this. No problem.
yeah, no issues.
Yeah.
And
So
one
coming back
student
to
is
our topic.
writing, as you said, every risk should have control coming to audit. How will this risk be identified? And what all proper control should be in change?
Yes, yes.
So I
So
think it will be covered in the slides. Yeah.
that's a very
Yeah.
very pertinent question, and
Yes.
getting there itself will take some time, because
Yeah.
we have to understand a lot of things before that. So definitely we will cover what you have asked, that we will cover. There is no doubt, because that for that purpose only we are here. So now
Right.
coming back to
Right.
the slide, coming back to the slide. So the first which we want to discuss is what is audit risk. So as we discussed, that audit risk is the risk that the auditor expresses an inappropriate audit opinion. So basically, what is a deliverable of an auditor? That is an audit opinion in form of an audit report, right? They have to issue an opinion in form of an audit report when the financial statements are materially misstated. So we have to say in our audit opinion whether the financial statements represents true and fair view or not. So that needs to be reported in the audit report, that whether true and fair view is represented through the financial statements or not, that needs to be shown. If at all there are certain misstatements which are material, we will cover what we mean by materiality also, that also we will cover. How do we compute materiality, that also we will cover. Everything we will cover. Just for now, you need to understand whichever material misstatements are there in the financial statements, those needs to be reported by the auditor, and that may impact his opinion. Opinions are of different types, you all guys must be knowing. Since that is not a part of this topic, so I'm not covering it. Just to give you an idea, that is, one adverse opinion is there, one uh, qualified opinion is there, one disclaimer of opinion is there, likewise different opinions are there. So but when an audit risk arises when there are certain inherent limitations, such
Sir,
as.
kindly make it full screen.
Yeah,
PPT
yeah.
on full screen mode. Yeah.
Yes, yes, yes. So basically, audit risk arises due to inherent limitations. So what are the inherent limitations in an audit which may result in an audit risk? It may be a risk that the particular company that is working in a particular industry, that may be an industry risk also. There may be a regulatory risk also. Say for example, a company called ITC, they are manufacturing cigarettes. So it is highly regulated, and every year on year, even in this budget, you will see that additional duty has been levied. So lot of regulatory intervention is there in that industry. So that may also be a risk, and there may be risk. Risk has to be categorized in two categories. One is controllable risk, and the other risk are which are not non-controllable. We will not be able to control through our procedures, and there are certain risks which we can control through our procedures. So there majorly risks arises where, like one example is judgment, where management has made certain judgments, like while creating provisions for bad and doubtful debts on debtors. So that also needs a lot of judgment, that whether how much percentage of provision has to be created, on which debtors we need to create provision. Similarly, if an entity is undertaking impairment testing of its assets, so in that case also judgment is involved, because in that case also we need to uh, create projections, and those projections have to be present valued to derive. So in that case, even the discounting factor may be a factor which may have a significant impact on the final result. So there also judgment is involved, which as an auditor we foresee it as a risk. Similarly, certain estimates, judgments, and estimates also may be there. Like for example, uh, a company is undertaking actuarial valuation done for gratuity and leave encashment. So they are basically they want to create provision for gratuity and provision for leave encashment. For that, they have obtained a report from the actuarial valuer who has provided that report based on various assumptions. So again, those assumptions needs to be validated or maybe assessed by the auditor for sufficiency or maybe appropriateness. So we need to see that. So that is also one of the major risk area. Then third is like audit sampling. As an auditor, it is very difficult since usually we have very limited time for audit. A company who is having a team of say 25 people, 30 people, finance and accounts team, they are working throughout the year to make a books of accounts and financial statements. And as auditors we go there and we have to close the audit within a period of 20-30 days. So it's impossible with a team of 2-3 people. So it's impossible that we will be able to verify or vouch everything whatever is there in financial statements. It's not a feasible task at all. So in that particular aspect, what we do, we resort to audit sampling. So when we are doing sampling, definitely a lot of care is involved while drawing the samples. We lot of scientific calculations are there, that based on which we do sampling. Judgment is there, everything is there, but still it carries a risk that out of say there is a population of 100 items, out of that we are just sampling 2 items. So risk remains with the 98 items. 2 items may be representative of 100 samples, but it's not necessary that in those 98 items there will not be any misstatement. So that also carries a significant risk for us. So that is also a kind of inherent limitation from the perspective of the auditor. And because audit evidence is persuasive rather than conclusive, so that makes we when we are using sampling as the basis, when we are relying on the statements made by the management, when we are discussing or inquiring the process owners, we are inviting their comments, we are considering that in our audit also. So all those things together make our audit evidences persuasive rather than conclusive. Now coming to what are the types of risks. The first risk, the inherent risk. So basically, in the previous slide, we have discussed a bit of it, that what do we mean by inherent risk? Like, I'll just give you an example. Say there is inventory in our books. So there will always be a risk because it is not possible for us to assess the situation of each inventory item. It will not be possible for us to cover all the inventory locations. It may not be possible for us to, and we are not competent enough also to understand whether a particular inventory is is about to expire. Maybe some expiry date and all will be there, but it's not possible for us to verify 100% of the inventory. So it carries an inherent risk for us as an auditor that we will be able to uh, draw comfort on that particular item for on the 100% of the population. That is a far cry as an auditor. But we undertake a lot of procedures through which we ensure that there should not be a material misstatement. So the risk of a material misstatement existing in an account balance or disclosure, assuming no related internal controls. So in this particular case, what we are saying that we are assuming that there are no internal controls in place, so then it will carry certain inherent risk. Now coming to control risk. Control risk, what does it mean? It says the risk that a material misstatement will not be prevented or detected and corrected on a timely basis by entities' internal controls. So this is very important to understand, because this particular topic is highly related to this. It is all about control, risks and controls. So When we talk about control risk, what happens? Every entity, whether be small or mid or large, every entity has to have controls in place in their organization. It doesn't matter, size doesn't matter at all. Definitely, for larger entities, they may have more formal processes in place. In smaller entities, the processes may be informal. But controls have to be there in place. No business can run without controls. Say for example, we will take an example of procurement to payment. Even during this whole session also, we will be discussing procurement to payment cycle, to give you an overview of what basically we mean by controls and how this whole process of risk assessment flows. Because this flow of risk assessment procedures needs to be understood very very clearly. Then only you'll be able to do justice to your role as auditor. Now coming to uh, detection risk, the third risk, this is a residual risk. So whatever comfort we are drawing through controls in the organization, whatever whatever controls whatever just a minute, hold on, just a minute, hold on.
Okay, sir.
Yeah, just a minute. हो गया ना?
I think, dear students, you are able to interlink it with chapter 3, right? And basic standards, wherein we have discussed about audit risk, inherent risk, control risk, and detection risk. Sir is explaining you with, and now after this, we will definitely understand with the help of practical examples
Yes, yes,
that
yes.
how practically we analyze, we assess the risk. Those practical documents are also there. After understanding the concept, we'll move to that also. So be with us.
Yes.
Yeah.
So
Yes,
should I
sir.
continue, Karunaji?
Yes, sir. Yes, sir.
Yeah, yeah. Okay. So the third risk, which is a residual risk, that is detection risk. So basically, detection is risk is for auditors. So whatever the quantum of the inherent risk and the quantum of control risks. Say for example, an auditor has gone through the organizational processes and have identified that what kind of control comfort they have on the organization's control structure, the control environment of the organization. So that they will try to assess. How they will assess, we will discuss definitely in detail. So they have assessed that okay, this organization has certain controls which are inadequate, or there are certain areas where they do not have adequate control, or maybe they do not have control at all. No control is there in place. So, and there are certain areas where they have sufficient controls and which is effective throughout the period. So in that case, what will happen? The inherent risk and control risk, if those two are high, control risk is high. If controls are not in place, the control risk is very high. If that particular item is a significant item in the financial statements and they do not have the underlying control, then in that case, that becomes a significant risk for us, and that is a control risk. So inherent risk and control risk, if these two risks are higher, then it boils down to the auditor to ensure that they have to keep the detection risk at the lowest by increasing the size of the samples or doing the additional procedures which they may not have anticipated at the beginning. So they will have to increase their procedures to minimize the detection risk, because the control risk and inherent risk are on a higher side. And in the vice versa case, where controls are robust in an organization, there the auditor may rely on the controls and may devise their procedures in a way to uh, have an overall comfort on the financial statements without getting much into sampling and test of details. Definitely they will have to conduct the test of details, sampling and all, but they did not totally resort into it. So they can minimize their procedures in such case. Now we let's take some examples. Now practical examples we were talking about. So here we have few practical examples of audit risk in audit of financial statements. The first we will discuss inventory overvaluation due to obsolete or slow moving stock not identified during physical verification. So in this particular case, what is happening? The auditor has decided that they will do physical verification of inventory. When they did the physical verification of inventory, they have identified certain items which were obsolete or are slow moving. Moving means the items have not been, say for example, a particular item's inventory is 100 pieces, but in the past 3 months, we see that only 2 pieces or 3 pieces have been issued. So that may be treated as a slow moving item. So in that case, they have assessed that inventory may be overvalued because the whole inventory is lying at its normal valuation, like maybe FIFO basis they have applied, or they have applied weighted average cost basis. So whatever inventory valuation they have done, since they have not factored in for obsolete or slow moving stock, there may be high possibility that inventory may be overvalued. So this is an audit risk which has been identified by the auditor. So this is one risk. Similarly, the next risk, if we discuss, this is related party transactions not disclosed due to management override of controls. Now we need to understand what do we mean by management override of controls. So basically, every decision in an organization is made by the management. If the management itself is biased, if the management itself does not devote sufficient time in management of the affairs of the company, if the management has overridden their basically rights. So say for example, board of directors has been entrusted to invest in a property, right? They have been entrusted that they can invest in a property, but they have invested in a property whose actual value say is 10 crores, but they have acquired that property at 15 crores. So that is nothing but that is management override of controls. Similarly, there may be certain aspects where shareholders, in case of a company, their shareholders approval is required, but the board went ahead or the management went ahead and they have taken decision on their own without inviting the approval of the shareholders, without taking the approval of the shareholders. In that case, that can also be termed as management override of controls. And more specifically, in case of related party transactions, this becomes this becomes utmost important because related party transactions are such transactions through which lot of window dressing can be done. Billing can be undervalued, billing can be overvalued. So any possibility is there. So related party transactions generally is considered as a significant risk in an audit parlance. For an auditor, related party transactions are generally considered as a significant risk. So controls over those related party transactions, that becomes of prime importance for auditor. Similarly, coming to fraudulent expense claims remaining undetected because audit sampling did not cover high risk vouchers. So as we discussed that detection risk we have to minimize. So in case of fraud is always considered as a significant risk. Fraud is always a significant risk because the intent of committing that fraud, the person who will be committing that fraud, he must be having significant experience in the organization. He knows the processes in and out. He knows how to disguise this particular transaction from the eyes of the auditor. So as soon as we come across an instance where fraud has been detected, so in that case we have to consider it as a uh, significant risk. And there are certain areas, like for example revenue may be an area, or maybe this expense claims may be an area where people may resort to fraud. So these areas become significant areas for us from the perspective of identification of fraud. And wherever there is a fraud, that will be considered as a significant risk. So in case we have resorted to sampling of expense claims, so definitely we will be sampling only a portion of the total claims. Not we will not be able to, with the paucity of time, we will not be able to cover everything. So we have to resort to sampling. So again, as we discussed earlier, if we resort to sampling, it does carry the risk of misstatement. Now coming to revenue.
Well,
Yeah.
sir, one query from Golti Anil Kumar.
Yeah.
The student is asking, sir, it will be very complicated to judge whether it is material or not. For example, while deciding the sample size, auditor need to keep in mind lot many other factors like time and previous financial information, etc. As an
Correct.
auditor, how can we handle this situation?
See, for that we have been given, जो बोलते हैं ना कि we have been given an arm, and that arm is materiality. So we will definitely discuss how do we compute materiality, but considering materiality aspect, that is something which gives us comfort as auditors, that materiality is there. Not every item, not every single item. Maybe if we look at the trial balance, in trial balance there are say hundreds of line items of expenses, and out of those 100 expenses, only 10 line items comprise 90% of the total expenses, but rest of the 90 items cover only 10% of the total expenses. So what do you think? Our focus will be more on those 10 items which comprise 90%, or our focus will be more on 90 items which comprise of only 10%? So definitely our focus will be on items which comprise 90%, even though those number of items are only 10. So there, what comes for our basically safety, that is materiality. That's the reason why, in our opinion, we always say true and fair view. We never say true and correct. If we say correct, it means that we have verified each and every transaction and have ensured that nothing is wrong there. So that's the reason why we are writing true and fair. We are just giving a reasonable opinion, a reasonable comfort to the stakeholders of the particular entity. So how we use materiality, how to compute materiality, all those things we will cover in subsequent slides. Just wait for a while, you will get clarity on everything, whatever doubt you have in your mind. Now the next aspect we will discuss is revenue overstated because of premature recognition near year end, not detected by cutoff testing. So this cutoff testing, this is a very important critical testing in case of revenue. So what we do in this, we pick up samples from towards the end of the period. Say for example, the financial year end is on 31st March 2026. Before that, the last 5 samples we have picked, and subsequent 5 samples we have picked. Like say for example, last 5 transactions have happened from 25th of March 26 to 31st of March 26, and first 5 transactions have happened from 1st of April 26 to 5th of April 26. So we pick those five from both the periods, and then we undertake cutoff testing on that. What do we do on cutoff testing? Revenue has a recognition policy that when what will be the trigger point for recognition of revenue. Say for example, I have an agreement with a client, with a customer, that I will, as soon as the goods leave my factory, it's your responsibility. The risk and reward will transfer to you. It will be your responsibility to carry the goods from the factory. So it's X factory. In that case, and take the second example simultaneously, that our responsibility is to deliver the goods to the premises of the buyer. So both the cases are there. There are two agreements in the organization, two types of transactions they are entering into. So what happens? Say for example, you can pick up last 5 days, first 5 days. You can pick up last 25 samples, first 25 samples. There is no guidance as such on that, but there we have to apply our judgment as auditors, that how many samples I have to, considering the nature of the industry, considering the transactions which are happening in the organization. So considering all that, we have to make the judgment that how many samples we will pick towards the end of the period, and subsequent how many subsequent sample will be picking. So for subsequent case, vice versa will be the case. Say for example, our arrangement with the customer is that once we have dispatched the goods, risk and reward transfers to you. So they have dispatched the goods on 29th March. Ideally, the revenue should have been recognized, but they have recognized that revenue in subsequent year to make the adjustments in their books for their comfort and convenience. So revenue also is always a significant risk, as is the case with related party transaction or fraud, where the areas which have fraud risk factor. So revenue also is considered as a significant risk always. Why it is considered as a significant risk always? Because this is one area which is overly used for for making adjustments in books of account, and that is why which makes cutoff testing more and more important. Now coming to provision for doubtful debts understated owing to high reliance on management estimates without sufficient corroborative evidence. So in this particular case, this provision which we discussed, because it involves high amount of management estimation. When management estimates, so definitely as auditors, we need to understand the basis on which those estimates have been made. That basis we have to understand. But naturally and usually, what happens that most of these estimates are based on certain assumptions. When assumptions comes into picture, then again some or the other way we have to rely to an extent, otherwise we will not be able to move forward. So provision for doubtful debts understatement, because it involves significant management estimate, is also a risk from auditor's perspective. So these are few examples, practical examples, where what kind of audit risk an auditor comes across while doing audit. Now coming to what is risk assessment. So basically risk assessment is a process. It's a systematic process through which the auditor identifies and evaluates the risk of material misstatement, whether it arises due to error or fraud, so as to plan appropriate audit procedures. So what happens? Say for example, we are auditing an organization. We are auditing an organization. In that organization, if we fail to identify certain significant risks, we have failed. Maybe we did not have adequate understanding of the entity and its environment. We did not have sufficient understanding of it, of the industry it is operating in. We did not have sufficient understanding of the regulatory compliances it has to do. So we have failed to identify certain significant risks which were existing in the organization. So do you feel that with this background, we will be able to issue a right opinion? So there is a high possibility that we will end up giving a wrong opinion. Even though there were significant issues in the organization, but since we could not identify the significant risk, so unless and until we identify risks, how we can plan our procedures accordingly to mitigate those risks? How we can plan? We will not be able to plan. So risk assessment is the most critical aspect in an entity's audit. Now, the next question is at what level this risk assessment has to be done? Whether it has to be done at the time of engagement acceptance itself, or it has to be done at the time of planning the audit, or it has to be done at the time of execution of the audit, or it has to be done at the time of reporting. Let me tell you, risk assessment is something which is a continuous exercise which has to be done, which has to be kept in mind throughout the audit. While accepting the engagement, even when we accept the engagement, every engagement carries its own risks. So that time also we need to conduct risk assessment, but not from material misstatement perspective, definitely that time. But at that time we need to see the credentials of the management, we need to see the background of the company, we need to see the public image of the company, then only we accept the engagement, right? So at even at engagement acceptance level we have to do that risk assessment, and if we are not satisfied with our assessment we will not be accepting the engagement. Now coming to the
So
next stage. Yeah.
one student is asking what is corroborative in evidence,
Yeah,
and
I'll come to it.
Hima
I'll
Bindu
come
is
to it.
asking, yeah, internal control however cannot detect or prevent management fraud, and their operating effectiveness is management's responsibility. Then why more focus on test of controls rather focusing on areas of management fraud?
Okay. So
And sir,
first,
now I would request, like you have make the students understand fundamental. If we
yes,
can
yes, yes,
switch to some practical documents so that they can correlate the same. Yeah.
yes, yes. We'll do that. We will do that. So basically, the first question which was asked is, what do we mean by corroborative? Corroborative. What do we mean by it is, if we say we have inquired with the management, we ask them that how many locations your inventory is in, how many locations you have your inventory. So they have said that they have inventory at say 20 locations, right? Now, what can be the corroborative evidence in this case? One corroborative evidence may be if we refer to the books of accounts, whether that books of accounts itself shows those 20 locations or not. If they are holding inventory in any location, they may have GST registrations, or they may have added it as an additional place of business in their GST registration. So even that GST registration can be seen. Then third corroborative evidence what we can have is, say we go there to do physical verification and we have seen that actually this inventory is lying in 20 locations. So that also can be one corroborative evidence. So corroborative evidence meaning is that whatever we come across based on discussion with the management or through a review of documents, so that has to be corroborated with certain other facts. So that we mean by corroborative evidence. So the example which I gave is a kind of corroborative evidence which we have obtained through doing certain procedures. Now coming to the second question which you have asked, that management, why we are not focusing more on management aspects, like there may be a risk of management fraud and all. So see what happens uh, when we assess controls in an organization, when we assess risks in an organization, what we do, we divide it in two parts. The first part is entity level controls and the other part is process level controls. Entity level controls is for the management, which may include what is the tone at the top. Say for example, let me give you a very very good example. Say there is a listed company. That listed company, in if you have seen, if you have gone through annual report of any company, you will see their management discussion and analysis para is there. One section is there, management discussion and analysis. In this management discussion and analysis, what the management does, they give you the indication of what they have, future, what future plans they have, how profitable the entity will be, what is the potential of the entity, what new expansions they are coming up with, what new projects they are coming up with. So all those aspects are covered as part of management and management discussion and analysis, MDNA section. Take one example. say as on 31st March 25, the annual report of the company of 24-25, we have gone through the MD&A, what the management has said, that what are their plans, or what basically what kind of foreseeability the business has. When we are referring to their annual report of March 26, we are seeing, or maybe even the quarterly financials, we see that out of 20 indications what they have given towards the betterment of the entity, only five items have actualized, and rest 15 are yet to be actualized, though the time frame which was suggested in that was about to, it should have happened till now, but it has not happened. So in that case, definitely it raises questions on the management, that they, what they are promising is they are over promising. They, what they are delivering is not what they are promising. So in that case, definitely reliance level on the commentary of the management will be lower. You take a vice versa case where management, whatever they are saying in their MD&A, and they are over delivering. So in that case, that mindset will be whatever they are saying, whatever they are promising, but actually what they are delivering is something much better than what they are promising. So definitely it creates an impression of the management in the minds of all the stakeholders, including the auditors. Say for example, I will take one more example. In an entity, we have seen that the company has created a provision for doubtful debts, 20% of the whole debtors. Take an example, 20% of the total debtors, they have created provision. So when they create provision, they will definitely debit that cost to the P&L. Subsequently, when we actually see in the next year, the entity has incurred 40% of bad debts, but they had the corresponding provision of only 20%, but actual bad debt is 40%. Take an example. I'm taking a very aggressive example, I know, but take this example. 20% was the provision, but actual loss is 40%. So what does it mean? It means that even though the management had an indication that they may incur this much loss, but still they created a lower provision, and significantly lower provision. So that again raises concerns on the management, whether we have to focus on the aspects where those management judgments are required. That's the reason why I said that wherever management judgment is involved, that becomes a very critical area for us for audit, that we will have to cover in audit. Else else if those remains unaddressed, it may impact your opinion. Now I'll just, as ma'am suggested, what I will do, I'll just take you through something which will give you a fair idea about what I'm talking about. Just a minute.
Sir, Anubhav is asking how can GST registration serve as corroboratory evidence on inventories?
No, for inventory, see, it may be considered as an evidence, not for inventory quantum of the inventory, but
Yes.
I just what I said, they are holding inventories on 20 locations, right? So for every location wherever we are storing inventory, we will have to declare that as a location even in our GST registration. So if we have declared that as an inventory location, so that gives us a comfort that okay, even though we are not visiting 20 locations physically, but still we can, it gives us an indication that there may be a godown where inventory is stored. So I'm not saying that is the conclusive evidence. That you can use as a corroborative evidence. That is not the only one based on which you will be able to take decision. So two, three items, four items together will give you comfort on whether that actually that inventory is lying over there or not. Even the physical verification reports of third parties that you can take. I just gave an example that may also be considered as a corroborative evidence in consonance with other documents. Now I'll share the screen. Hope you are able to see my screen.
Yes, sir, we are able to, but the files are being shown, not that file is shared on the screen.
Okay, let me reshare it.
Yeah.
Now it is visible.
No, sir.
No,
Yeah, now it's visible. It's
now
visible now.
it's visible. No, okay.
Yes, yes.
See,
If
so
you can
friends,
just zoom in.
yeah, yes, yes. Now it's okay.
Yes.
Yeah. So see, this is a typical risk control matrix where we have identified risks and we have corresponding controls mapped to it. It's not necessary that for every risk there will be only one control. It may be possible that against one risk there may be three controls which together are mitigating that risk, and there may be such control which may be addressing more than one risk. So it may be vice versa also. So I'll just take an example here. Just take an example that the process is procurement to payment. So basically this is the typical business cycle of purchases. We have purchased goods from the vendors and we are making payments to them. So basically this particular cycle is covering that aspect. Now coming to sub process is vendor selection. So my first sub process here, what has been documented here is I have to select vendor. Now who is the process owner for this vendor selection? The process owner is the consumer purchase head manager, and president operations is also involved in it. So this is a practical example which I am giving, which we have done for an organization, but I've removed the names of it to not divulge the details. But this is actually a practical example what we have done. Now, in this particular case, if you just go through the control objective, what is the control objective? The control objective is to ensure adequate control over vendor selection process. So our objective is to ensure that vendor selection process is appropriate or not and adequate or not. Here, this we will discuss. You are seeing the C stands for completeness. So these are the financial statement assertions. This we will discuss going forward in slides. So what this particular item is addressing these two assertions. First is completeness, and the second is existence or obligation. Existence is in case of assets, and obligation is in case of liability. So, in this particular case, in vendor selection, these two assertions have been identified, which it will be addressing. Now, whether there is a fraud risk in this case or not, there may be a fraud risk or not. You tell me that in case of vendor selection, there may be a risk of fraud or not. Yes, there may be a significant risk of fraud, because if the process owner ties up with the vendor, he can definitely commit fraud. But in case where there are robust controls, even though the vendor selection is being done by a person, but it is being approved by someone else, in that scenario, this fraud risk may be reduced. But yes, primarily there is a fraud risk in case of vendor selection. And wherever there is a fraud risk, as I said earlier, it is a significant risk. Now, this COSO component is basically for basically internal control purposes. Many entities follow COSO framework. That is a globally accepted framework for controls. So that COSO component, they are considering it as a control activity. This I am avoiding. Now, here, what is the risk involved in this case? Risk is selection of incompetent or suboptimal vendor, resulting in supply of substandard material or delay in supply of material. So what is the risk involved here? That either the vendor may be incompetent, or the vendor may supply suboptimal articles, or the vendor may delay the supply of material, which may hamper my operation significantly. So this is a risk. And apart from that, the other risk may be that that vendor may be associated with the process owner. That is the risk which is unsaid here, but that risk always remains. Then risk rating, since it is a fraud risk factor, as I said, the risk rating will be high. It is a high risk which we need to address through our procedures. Now, against this risk, what control the entity is exercising presently? So what they are saying, before adding any new vendor, following things are ensured. They obtain vendor profile, they request for proposal, quality specification and sample testing happens, certain parameters are converged regarding the raw materials and consumables to be purchased beforehand, that specifications of the material, and geographical area also is taken into picture while inviting quotations or while selecting vendors to reduce their transportation cost, because it may impact any purchase significantly, the transportation cost. For continuing vendors, past history is inspected before selecting that vendor for a particular purchase. Whether in past, say for example, in past we have ordered certain items to a vendor who delayed the delivery, or maybe the goods he provided were suboptimal, were not meeting the specifications which were provided to them. So if that is the history of the vendor, definitely we will not be selecting that vendor for further orders. Now coming to key or non-key control. So what does it mean? As I said, that one risk may be addressed through one or more controls, but there will be a primary control which will be addressing a particular risk. So that primary control is called key control. And non-key controls are certain associated controls which assist, which in if we club it with key control, then we will be able to mitigate the risk which we are talking about. Now we also need to see what kind of what is the nature of the control, whether it is automated control or it is a manual control. If the control is automated, it gives us lot of confidence, lot of comfort that this is happening automatically through system. But if it is a manual control, then again it is a person driven thing. If a person is doing it properly, adequately, then it will happen. If he is not doing properly, it will not happen. Say for example, there is a maker checker control in case of say an organization is preparing bank reconciliation statement. A person is preparing it and the other person is reviewing it. The person who is preparing it, he is preparing it on a monthly basis, but the person who is reviewing it, he just signs it without getting into the details. So even though the process is there, the control is defined, control is there, but is it effective? It is not effective. Even though the control is implemented, but it is not effective. Now, next aspect which we need to see, whether the control is a financial control or is an operational control. That segregation also needs to be done. Now, this is very important. Whether this is a preventive control or it is a detective control. So generally what happens as auditors, we rely more on the controls which are preventive in nature. If something is taken care of at the root level, if vendor selection itself is having a significant control, that no incompetent vendor or no vendor who provides suboptimal articles will be onboarded. If we have sufficient maker checker control on that, that becomes a preventive control. But detective control is something, in this example, what could have been a detective control, that okay, one vendor has been selected, we have transacted with them for twice or thrice, but after three times, again we are seeing that similar issue is repeating with the vendor. Again we are placing the order with him, and then again we are detecting the issue, we are issuing a debit note to the party. So that process is going on. Every time they are supplying us suboptimal articles, and we are issuing debit notes on them. So that becomes a detective control. But here in this case, since vendor selection process is there, it is a preventive control. Frequency as and when required. So basically frequency of certain items may be event based. Frequency of certain items may be monthly, quarterly, half yearly, annually, daily. So any frequency may be there. So every control and for every risk, we identify the frequency. At what frequency this particular control is exercised by the process owner. Then testing. Now comes to, once we have understood the control and we are comfortable with the design of the control, with the implementation of the control, then we go ahead testing the control whether it is effective or not. So that aspect is covered here. If I open this particular document, this is not opening. Just a minute. See, if you see this list,
Sir, just zoom in. Yeah.
yeah,
Little bit more. Yeah.
yeah,
Thoda और.
ठीक है अभी.
Yes.
Yeah. So if you see this list contains the list of vendors who provide consumables to us, and there is a list of vendors which who provides raw materials to us. So what is this list? This is basically an approved vendor list of the organization. So for consumables, they have this list of vendors through whom they can invite quotations for consumables. And for raw materials, these are the vendors from whom they can invite quotations from for the purpose of procuring raw materials. So this list is very important because this list has been compiled based on the experience of the entity with the vendor. What has been the history of the vendor, whether they have performed to the needs of the organization or not, the goods they provided by them were in line with the specifications, the prices they have charged, or the billing which they have done, that is in line with the market. So all those aspects have been taken care of, and they create a list of vendors which is approved by the management. Okay, you can transact with these vendors. Now, if a particular entity wants to add a new vendor, then again another process has to be followed. That preliminary due diligence of that vendor will be done before that vendor is added to this list of vendor, which is an approved list of vendor. So every organization who is procuring materials or procuring services all those organizations maintain a list of approved vendors. If an organization is not having any approved list of vendors, that can be considered as a lacuna in the system that we can highlight as part of our control recommendations, that you should have a list of vendors in place which should be approved by the management, and that should be totally dependent on the performance of the past performance of the vendors. And in case you want to onboard a new vendor, this is the SOP which you need to follow. That SOP also has to be implemented. So this is one example. Likewise, in this particular case, we identified certain gaps which have been captured here in to be implemented. Before selecting the vendor, the following should be ensured: request for proposal should be there, geographical area also needs to be considered because they were practically not considering it, and what is the standing of the vendor in the market, what is the actual process, this has been documented here. So similarly, if you go down other sub processes also, you will see the similar pattern. So we will come back to this sheet. I have just shown you the structure of this sheet, that how risk control mapping is done and how risk categorization is done. So that aspect I wanted to just show you. We will again come back to this sheet when we go through the whole procurement to payment process. Then we will come back to this sheet again. For now, I am moving to another slide. 1 minute. Let me share.
So one of the student is asking,
Yes.
why should auditor take into consideration vendor mention specification? Uh, isn't it non-financial matter as we considering vendor specification matters?
Can you come again? I just missed it, and I think
Basically,
one message also I have received from from your side. Okay, got it. Yes, yes. You carry on, please,
actually,
ma'am.
yeah, well, that background is na, so that's
Yes, the background,
not.
because I did not receive the background, so I thought that I should place this background.
Okay, okay.
Uh-huh.
So, why should auditor take into consideration vendor mention specifications?
Vendor
Question is,
mentioned specifications.
Hanj.
No, see, basically, while assessing internal controls, we need to understand what organization is doing for the purpose of vendor selection, because that carries a risk of fraud. So for understanding that, you need to understand whatever is happening there. Everything we need to understand, we need to understand it in depth. So whether it be specification, whether it be other aspects, we need to understand everything. Otherwise, unless and until we have a fair understanding of the whole process, we will not be able to identify gaps. We will not be able to identify risks which remain unaddressed. So control lapses we will not be able to identify in that case. So definitely the extent of procedures you can decide based on your judgment. But let me tell you, even this is a part of our statutory audit. When we do statutory audit, the samples which you undertake for controls testing, we test even for this aspect also. We have to do that. I'll just share the slide now. 1 minute. Yeah, PPT is visible, na?
Yes, it is.
Yeah. So here, first aspect which we will be covering as part of risk assessment, that is understanding entity and its environment. So how do we understand the entity? So I will again share another document where you will get to see that how understanding is done. 1 minute. वन मिनट
सर वो शेयर्ड फाइल अभी नहीं विजिबल है.
हाँ हाँ, मैं शेयर कर रहा हूँ, 1 मिनट.
एंड सर अगर आप बैकग्राउंड जस्ट एक रिमूव वीडियो करके अगर इसको हटा दें तो भी इफ
ओके,
पॉसिबल, नहीं तो अदरवाइज लेट्स मूव विद द फ्लो ओनली.
so let me complete this understanding part, then I'll remove it. Huh?
ओहो, नो इश्यूज.
Yeah. See, generally, process flow, whatever process flow is there in the organization, that process flow can be captured through flowcharts. Generally, in large setups and mid-sized setups, they have SOPs
So
in place.
we need to zoom in actually. It's not visible.
Okay, now it's visible.
Yeah, yeah.
Yeah. So generally, what happens in large setups, they have SOPs and manuals in place for everything. Say, for example, for procurement to payment cycle, also, large organizations will have SOPs in place where they have flow charts of the process flow, which will represent the process flow right from the vendor selection, right from the purchase acquisition till the payment to the party. They will have the whole flow, and also they will have the narratives of the process flow. So those are the part of the SOP itself. So in that is the case with the large and mid-sized setups. In smaller setups, usually they do not have any SOPs. Even a lot of mid-sized setups also, they do not have SOPs in place. So there, in order to understand the process, we ourselves need to create process flowcharts. If the client is not providing or they do not have it in place, we need to understand the process, so that we do through process flowcharts. And we like the one which you are seeing on your screen. And we also create something called SIPOC chart. SIPOC is, though the term seems a bit catchy, but it's very simple. Generally, in any process or in any audit, what we do, input, process, output. So that is a very usual thing, that there is some input, it is processed, and then we get output. But in this SIPOC, what we have extended it to two more parts. The first part, it starts with the source. What is the source of this input? Then this input is processed, then we get the output, and finally, who is consuming this output? I will just take you through one example, then you will understand what exactly I mean by it. How we get the understanding of any department. Say, for example, this is the procurement to payment process. The first source department is the user department, which has created, which has raised an indent. Say, for example, it is a manufacturing setup. In that manufacturing setup, they need the raw materials. Their raw material, what they are already having, that is not sufficient for the production cycle. So they have issued an indent. So indent will be issued by the process owner who is there in the user department. He will be raising the indent or purchase requisition, you may say. Not purchase acquisition, requisition. So that indent, you can consider it as an unapproved indent till the time it is approved by the departmental head. Say, for example, in that production department, there is one production manager and there is one production head. Production manager has issued an indent for getting certain raw materials. That unapproved indent if you just read through the process, individual departments, after identifying any requirement of a material issues an indent via they have a software in place. So via software, they have raised an indent. They will raise indent to whom? The user department will raise this indent to the purchase department, or if they have store in place, they will issue the indent to the stores department, that if at all that particular item is there in the store department can issue that material to the user department. So in this particular case, they have a store department in place. So this indent the department has issued, and which is outlining their requirement of material issues. Output is unapproved department and it goes to the stores department. So in this case, ideally, if you see, in this case, ideally, there should be a checker of this indent. Ideally, it should have been approved by the user department head before it goes to the stores department. So that check is missing here. Now coming that indent, say that unapproved indent has come to the stores department. Now what stores department will do? The stores department then updates the stores data in the software, as in how much stock of that item is lying with us. They have updated it in the indent itself, indent data, that okay, this material is available with us, or this material is available with us but partly available with us, it is not fully available with us. Say for example, they have requisitioned for 100 tons of that item, but we have only 20 tons in place, 80 tons we'll have to procure separate from our vendors. Then this updated information, who will be using it, who will be consuming this information? This information will be consumed by the user department. Okay, store, so we have 20 tons in place with the stores department, and rest of it we will have to procure from outside. Now there certain observations are there. Currently the ERP cannot generate the report of stock data updated by the store department, cannot be verified if the data is correct. Also linking of tally and document is not done. So at every activity level, we are trying to identify observations also, that what process lapse is there, what control lacuna is there, how this process can be further improvised. So those observations we keep on identifying. Then in this case, since consumer was the user department, I am talking about cell E3. The consumer was user department. So the consumer in the next activity becomes the source. So now if you see A4, their user department is there. Now this user department, what they do, updated and unapproved indent, they have given to the HOD for approval. So first what they did, first they have confirmed from the stores department whether that material is lying in the store or not. They updated that information in the indent, and then they have given that indent, updated indent, to the head of the department for approval. Now head of the department reviewed that indent to ensure that actually this material was required or not, and then the user department head approved this indent. Now again, who is consuming this particular approved indent? Now it is again with the user department only. Now this user department, this indent, the user department will be sending to the purchase department. If you see user department, now the input is approved intent. What is the process? If the items are unavailable with the stores department, the intent is approved by the respective HOD and it passes to the purchase department for issuance of PO. So in this case, approved indent, output is approved indent itself. There is no change in the output. Input remains the because it has already been approved by the HOD. Now coming to this indent came to the purchase department. Now the ball has passed to the purchase department from the user department. Now purchase department has to take action on this purchase. Now again, the source is purchase department, because in the earlier activity, purchase department was the consumer of that information. Now purchase department becomes the source for the next activity. Similarly, this approved indent, based on this approved indent, purchase department then selects vendor based on past experience, availability of materials, price or urgency, and then prepares a purchase order accordingly and are sent to the vendors. So if you just see this flow of SIPOC, so there are two ways through which we can capture the understanding. Either we can capture it through a flowchart, or this is also a kind of a flow diagram, flowchart, but it's in the form of a matrix. It's in a matrix form. That certain information is being in a tabular form, rather, I would say. It's in a tabular form where from source to consumer information is being captured, and it goes till the end. And the last activity, if you just refer to, we will again come back to this sheet when we discuss the whole thing. If you see the last, uh, I'll come to, just a minute. See here in this item, if you refer to A21, cell A21, stores department, invoice has been received from the party, MRN material receipt note has been generated. So this way it goes on till the payment has been made to the party. So this is the process through which we can capture information, where we know what all information we have. We know what is the process which is being followed in the organization, who all are involved in this process, who is the preparer of certain information, who is the reviewer of that information, what is the document which is being generated through that process, whether it be indent or a purchase order, what document is being generated, who is authorizing that document. All that information is being captured here. So if we create something like this gives us a fair understanding of a process. So this, I'm talking about the process level understanding. So either you can do it through flowchart or you can do it through SIPOC chart. So coming back to my presentation, yeah,
Saminathan is asking what is the difference between SIPOC and SOP?
pardon?
SIPOC and SOP.
Okay. No, see, you can say these are variants. So basically SOP is something which is very comprehensive. It is very comprehensive. Every organization who is having an SOP in place, that SOP is very, very detailed, and it encompasses. If you just allow me a minute, I can show you an SOP also, how it looks like.
Sure, sure, sir.
Just
Saminathan
wait
sir
for
is
me.
showing you SOP also.
Yeah, so that will give you a fair idea what is the difference. Just a
Right.
minute. Hope it is visible.
Yes, sir. Yes, sir.
So see, this is a purchase department SOP of a company. Okay. So in this SOP, if you see, a document number has been allotted, creation date, revision date, on which date it has been revised, who has prepared it and who has approved it. Okay. Now just read through the purpose of this SOP. So in every SOP, there has to be a purpose. Our SOP of purchase department is defined as to obtain the optimum level of organization's inbound supply chain cycle, to keep this cycle uninterrupted. So that purpose has been captured here thoroughly. What is the purpose of this SOP? Now coming to what is the scope of this SOP, what all it will cover. So it will cover the corporate office, it will cover the plant 1, plant 2, all these things they will be covering. Now, what are the divisions which are there? All those divisions have been mentioned here. Then who has the responsibility for implementation? That has been captured here. Now coming to comparison, this is a existing flowchart, process chart, present practice, new proposed practice. So basically this is at a draft stage, that is why you are seeing like this, that present and new proposed practice. So this is the flowchart. Earlier this was the process, now this will be the process. So that process flowchart will be there. Post this, now detailed narrative will be there. What is the process activity, what is the process detail, and who will be the process owner. So this activity will be there. So activity wise flowcharts, activity wise narratives will be there. Just see, you'll get to know. And see what all documents are, process documents are there, like purchase acquisition, vendor panel. Everything has been detailed here, that what it should include, what all fields should be there. It is very detailed. So it's a big document. Who are the in case of emergency purchase, what will be the process? That process has been given there. In case of any amendment required in the purchase order, what will be the process? In case of cancellation of purchase order, what will be the process? Material rejection. So basically, this is a detailed SOP. If you see, it's a 29-page SOP only for the purpose of procurement. I hope now you are able to understand. See, that SIPOC document, that is for our purpose. As auditors, we are gaining that understanding, and we are creating a document to document our understanding of the process. For that purpose, we are creating it. But SOP is generally prepared by the management to assist them in their process, that people should not have any confusion in the process altogether. They shouldn't have any confusions. So that is the reason why SOP is in place. They should be aware that after this particular activity, what next activity I need to do. But as auditors, we are trying to understand the process so as to identify risks what are involved in the process, and how robust are the controls which are addressing the risk. For that purpose, we are creating that SIPOC document. You can create, see, there may be different forms in which you can prepare document. This is not a form that has to be holistically followed. It's not like that. This is one form in which you can create a document. You can just have input, process, output. Here, to make things more clearer, what we have done, we have also captured source, and we have also captured the consumer to make it more clearer. So it all depends on you, what extent of documentation you want to do in your audit. Right? Now coming back to my slides. Yeah. So now what we understood is, that is a
Just make
process
it
level understanding we have identified. A process level
full
understanding we have
screen.
done. Hello?
Full screen, sir. Full screen. Make it full
Yes,
screen.
yes, yes, yes. Sorry. So now what we did was the process level understanding. But we also need to understand the entity and its environment. When we say understanding the entity, we need to understand its business, in which business it is into. We need to understand the industry which it belongs to. What are the specifics of that industry? At the example which I gave of ITC, of their cigarette division, there are certain specifics to that cigarette division. So those specifics needs to be understood, that are there any specifics about this industry? What are the regulations? What are the regulations which may have a significant impact on this industry, or which govern this industry? Say for example, for banks or NBFCs, RBI governs it. Say for capital markets, SEBI governs it. Say for insurance market, IRDA governs it. So governing authority may differ, and accordingly their requirements may differ. So that understanding also should be in place, apart from the understanding of the business itself. And process level understanding also we need to have, to actually identify the risks. As I said, that risks may be at engagement acceptance level also, it may be at entity level also, there may be certain risks, there may be certain risks at management, there may be a risk of management override of controls also, there may be risk at process level also. So at every level there may be a risk. Now it's up to us how we want to address those risks. Now coming to the next aspect, which is identify inherent risks. So every industry, every business, every entity may have certain inherent risks. So we should be, as auditors, we should be aware of what inherent risks are there in an entity. In the example of ITC, cigarette division, there is a significant risk of the regulatory policy. Maybe tomorrow a state government comes and they ban cigarette. In case of alcohol, if you see Bengal, Gujarat, Bihar, Gujarat, those states banned it. So that is a significant risk, business risk, which may happen in any organization. It may have a risk on their going concern even. So similarly, any state may come up with any regulation, any government may come up with any regulation, any regulatory body may come up with any regulation which may have a significant impact on the business of the entity. So we need to identify what are the inherent risks associated with this business of which we are doing the audit. So those risks have to be identified. The next is identification of control risks. As I said, if you refer to the previous document which we were looking into, we had certain observations with respect to unaddressed risks, where that risk control mapping sheet was there. Against that, we had certain observations. Those are nothing but control risk observation, where we feel that there should have been certain controls which are not there, which are lacking. So that may be a risk area as an auditor for us. So then evaluate the effectiveness of internal controls in preventing or detecting misstatements. Now, accordingly, whatever understanding we have obtained of the entity and its environment, of its processes, we have identified the inherent risks, we have identified the control risks. Okay, these are the control risks which are there subsisting in the entity. So accordingly, we have to tailor our audit procedures. So audit procedures, then we need to assess that how much we can rely on the controls, how much, what is the quantum of the inherent risks, what is the nature of the entity. Based on all that, we have to tailor our audit procedures, and accordingly we need to devise our process that how we should gather that confidence which we want to have before issuing an opinion. Now just look into these two examples. Revenue recognition. The area is sales revenue. Risk has been identified as overstatement of revenue. Revenue has been overstated. This is a risk area as per the auditor. Now, what is the reason behind why he is thinking that this is a risk area? Because the entity may have pressure to show higher profits. When this situation will happen? There may be two, three examples. Sub examples I will give where there may be pressure to show high profits. Say, for example, the entity has availed loans from banks. When they sanctioned the loans, the entity had given them some projections that okay, the business is expected to operate like this and it is expected to earn these profits going forward. Now, what banks will do, when depending on the actual position of the entity, how much profitability it has earned, they will compare the data which was provided to them at the time of the sanction of the loan, or maybe period on period, every quarterly maybe they will have to submit the financial data with them, or maybe every half yearly or annually they will have to submit the data. So whatever data they have, whatever projections they have received from the entity, and what actual profitability they have achieved, if there is a significant gap, banks get desperate that okay, I think there is a risk, credit risk. Then they start creating pressure on the management ki why profits are so low in this quarter, what has actually went wrong. So all those things come into picture. Then if that is the case, then there is a huge pressure on the management to show higher profits. Similarly, if an entity is a listed entity, if to maintain the market capitalization, to maintain the share prices, the entity will have to show consistent profits. So even if in cases where maybe their profits have been compromised, but still they will they will resort to certain practices where they can make profits consistent, either by understating of expenses or overstating of revenue. So that is always a risk area, and these are the situations where the management may face significant pressure to show higher profits. Now, year end cutoff manipulation, as we discussed some time back, that in revenue recognition, cutoff testing is a must, because uh, uh, if an entity has recognized certain revenues beyond its recognition policy, that is also a significant risk. And if they have understated the revenues, that is also a significant risk. In the present case, since there is a risk identified of overstatement of revenue, so cutoff majorly will entail uh, aspects which are related to overstatement of revenue. So ideally, we will see that next year revenue, the items which should have been recognized in the next year, they have been preponed to the current year. So that needs to be seen. Then here, risk type, it is an inherent risk. Anyways, revenue recognition is an inherent risk generally. And since this risk, considering these factors, pressure to show higher profits and year-end cutoff manipulation, so this becomes a high risk area for us. Similarly, in case of inventory valuation, take the second example. The risk identified is inventory overstatement. What is the risk? Say for example, this particular company is engaged in manufacturing of pharmaceutical equipments. So medical equipments, in case of medical equipments, what happens? uh, there are significant technological advancements in a very very short period of time. Technologically, a lot of new things keep coming in, and those machines are extremely costly. All those medical equipments are extremely costly. That may there are certain equipments which cost maybe upwards of 1 crore, 2 crores, 5 crores, any amount for that matter. So those are very costly equipments. So in that case, if a company is into manufacturing or trading of medical equipments, there is a high chance that there may be certain equipment in inventory which have become obsolete, or those are slow moving stock. There were very few consumers are there who will buy that machine. So that is a significant risk in that case. Even in case of IT equipments, in case of mobile dealerships, this is a significant risk that any particular device may get obsolete, or it may be slow moving. So it will definitely impact the inventory valuation. Similarly, estimation involved in valuation. So see, in valuation also certain estimates are there. When we derive the cost of inventory, their cost of material, cost of conversion cost is also captured. Then certain overheads are also captured. So generally people play with overheads, at what cost should be formed part of the inventory and what cost should not form part of inventory. So in case certain items have been included there, which actually should not have formed part of the inventory, that will definitely impact the valuation. Similarly, what happens? uh, say for example, a company is into coal trading. It has a huge heap of coal. There may be there, and the coal is of different grades. If you are aware of that, grade wise coal, how much basically calorific value each of that coal stock is having. Accordingly, valuation is happening. How much moisture content is there? All those things are there. So in those cases, estimation had to be have to be made, because you will draw sample from one location, one heap, or maybe a portion of that heap. But in the whole heap of coal, what other grade is there, it is very difficult to identify. And as auditors, we are not at all competent for that, so we will not be able to do that. So for that purpose, we may need to even hire experts also. We can ask management to hire an expert, so that they can provide a reasonable estimation to us. Okay, this is the value of this inventory, right? So there, in these cases, there may be estimation involved in valuation of inventory. So this is also, again, if we consider these two reasons, the risk involved is high, because inventory is such an item which is generally material, and it is a high risk item. Then control risk, if we refer to the control risk, here we can consider it as medium, because company may have certain controls where they are where they are taking opinion of an expert, as in, while getting the inventory valued, they are asking the expert valuation done, and that valuation is provided to us. So control wise, they are trying to implement that control. So control risk may not be that high, but inherent risk is definitely high. So this is just an example of risk assessment. Acha, two questions I have for you. I need your responses. You can just read it through. The auditor's assessment, the auditor's assessment of detection risk should always be higher when the financial statements are subject to significant inherent risks, as higher detection risk is a necessary response to high inherent risk in the audit approach. So it a true statement or a false statement?
The students, we are waiting for your answer. You need to tell that whether this statement is true or false. Rather, you can give your answer simultaneously for both. You can write for one
Yeah,
it is true or
for
false,
both they
and
can
for
write
true.
they
Yeah.
can read through it. I'm
Yeah.
giving you 2 minutes time. You can read through
Yeah.
it and
If
you
you
can give your
want,
response.
yeah, if you want, I can read the two also. In second statement, it is written if the inherent risk and control risk are both assessed as low, the auditor can still face a high detection risk, which may require them to perform more substantive procedures to achieve the appropriate level of audit assurance. Now, you tell that it is true or false, right? So, we are waiting for your answer. For first, you need to tell, and for second also. So, simultaneously, you can write because maybe due to network, we will receive your answer later on. So, you please write together for both. Yeah. So, Anil has written one is false and second is true. One more student
Okay.
has written one is false. Then actually, due to when we speak right, like it takes time to students also.
Okay,
The
okay. No problem. I will explain it. So
yeah.
let us get one, two more responses, what they are saying. Okay, so what are the majority
One is
answers?
writing, Hema Bindu is writing both true. Then Dimple is writing one false, second true.
Okay.
I
So,
think now because we
okay,
will
okay.
run short of time, so we can explain
No, no problem.
that.
I'll explain it. I'll
Yeah,
explain it.
yeah,
So
yeah, please.
in the first case, what is there? That what is saying that inherent risk is significantly high, subject to significant inherent risks, as higher detection risk is a necessary response. So if the detection risk is higher, so when the detection risk is high, when our when our procedures which we have followed is not adequate. Just try to understand what I mean to say. That detection risk, say in an organization where inherent risk is high, so in that case we will have to ensure that detection risks should be at acceptably low level. We cannot keep detection risk higher. The reason being, we have to ensure, because inherent risk is high, so we have very less scope for detection risk. We have to keep it at acceptably low level. And how can we keep it at acceptably low level? By doing sufficient audit procedures, by
They're
applying
almost
sufficient.
all are
These,
on
so
the
the
same
answer
line
will be
except
false.
Ranjan. Yeah, Ranjan and Samyanathan, they have given different, that first is true and second is false. And Samyanathan is saying one is true and second is also true.
No, no, no.
So
So,
here
okay.
different answer is there. Yeah,
Yeah, so
yeah, yeah.
different answers we are getting. So let me explain it and clarify to them. So see, please understand, if inherent risk and control risk both are high, or in combination both are high, in that case we will have to ensure that detection risk remains at acceptably low level from auditor's perspective. And how we will ensure that? We will have to extend our audit procedures further. We will have to do more sampling. Say for example, if a population is having 100 items, earlier we had decided to do only 20 items testing. Now we will have to extend it to 40 items, 50 items, based on our judgment, to keep the detection risks at the lowest level. So the first statement, that's the reason why the first statement will be false. It's not true. Even the second statement, the answer will be false. The reason being, what it is saying, if the inherent risk and control risk are low, we have assessed that as low. Why? Because that industry is not prone to, that industry or that business is not prone to significant inherent risk, and their controls are robust, which is keeping my control risk at low. So both combined, I have assessed that those two risks are low, not on a higher side. So in that case, even though if I restrict my procedures to a limited extent, but still detection risk will be low, because those two risks are lower. So even though we restrict our procedures to a lower level, still we will ensure that there will be not be much detection risk, because the controls are robust there. So here in this statement also, this is a false statement. So please mind it. If controls are weak, if they are significant inherent risk, then the auditor will have to extend their procedures to ensure that detection risk remains at the lowest level. We don't have much scope for detection risk then. But if an entity is having robust internal controls and it is not having significant inherent risks, so in that case we can, because the processes in the company itself is keeping our detection risk at lowest level, so we can restrict our procedures accordingly. I hope I'm able to make it clear for you. So moving to next slide, if anyone has any concerns or any questions, you may please ask. I will try to address that. So if we just read through these answers, detection risk should be lower, not higher, when inherent risk is high. The auditor needs to compensate for high inherent risk by reducing detection risk to an acceptable level, not increasing it. So that's the reason why it is false. For the question 2, the reason, again the answer is false. If both inherent and control risks are assessed as low, detection risk can be higher, but it does not necessarily require the auditor to perform more substantive procedures. In fact, the auditor may reduce the extent of testing if risks are low. Reason being, the processes in the organization are so robust that they itself is taking care of the errors or frauds. So that's the reason we can keep our audit procedures, we can restrict our audit procedures to a limited extent. Hope now it is clear for you all. Now coming to internal controls. So as we discussed, that internal controls are responses to the underlying risk. Every risk should be responded by a control. There may be 3 4 situations in case of internal controls. 3 4 types of situations. What all? One situation may be in a particular process there is no control at all. There is no control. There is no maker checker control, no segregation of duties. There is conflict of duty. So all those things are there. So no proper control is there at all. Second situation may be control is there, but it is inadequate. The example which I gave, that BRS is being prepared by a person, but there has been no, and one reviewer has been assigned, but that reviewer is not signing any of those bank reconciliation statements. So even though that control is there, but it is not being exercised. Then third situation may be कि control has been defined in the SOP, but it has not been implemented. Say for example, take the same example, BRS, maker, checker, but that checker is not checking it, that the control itself has not been implemented, even though the control has been defined in SOP. And the fourth situation may be that control is defined, it is implemented, but it is effective only for a partial period. Say for example, say a promoter or an auditor raises a concern to the organization, the process owner maintains the process of maker checker control for the first 3 months, and for rest of the 9 months they did not implement it, they did not kept it effective. So what happens, that control was effective only for three months, but it was not effective for the rest of the 9 months. And one more situation may be that reviewer is signing the BRS, but he is not properly reviewing it. Even though that process is there, that is implemented, he is doing it, but the control itself is not effective because he is not reviewing it properly. So what are internal controls? They are processes, policies and procedures designed to provide reasonable assurance that an organization's objectives are achieved. What are the objectives of internal controls? Reliability of financial reporting, efficiency and effectiveness of operations, compliance with laws and regulations, safeguarding of assets, and prevention and detection of errors and fraud. Now here, let me tell you one thing. Here it is very important to understand the difference between internal controls and internal control over financial reporting. As auditors, we need to report on internal controls over financial reporting. But to identify the risk of misstatements, we need to understand the internal controls. Now the question will be, what is the difference between the two? So internal controls is the whole gamut of controls what an organization exercises to ensure effectiveness of its operations, to ensure compliance with laws and regulations, to safeguard its assets, and to detect errors and frauds. Whole gamut of internal controls across the business cycles. But when we talk about internal control over financial reporting, that reporting requirement is there in Companies Act in section 143.3 and 134.5. That is there, that requirement that we need to report on IFC, internal financial controls. So that means that right from the capturing of data at the book entry level, when we are recording transactions in the accounting software or accounting records, from that level to the financial reporting level, whatever activities are happening, that we need to ensure the stakeholders that financial reporting is being done appropriately. So right from data capturing till the data capturing, recording of transactions, till the financial reporting, the process is operating well in the organization. That comfort stakeholders wants from us. Otherwise, what will happen? Books of accounts will saying, say for example, take an example of inventory itself. As per books of accounts, the figure of the inventory is 10 crores. But in financial statements, we are seeing a figure of 15 crores. So there is a disconnect between the two. So unless and until we give the comfort to the stakeholders that what is there in the what has been captured in the books of accounts has been effectively presented in the financial statements. So that is one example of what we need to check in ICOFR, internal controls over financial reporting. But as an auditor, for the purpose of a statutory audit, we need to understand the whole gamut of internal controls which may have an impact on the financial statements. So, for understanding, we need internal controls, and for reporting, we report only to the extent of internal control over financial reporting. So, please understand this. This is a very, very important bifurcation because I've seen even many professionals who get confused between internal controls and internal controls over financial reporting. Now, today, how much time we have,
Sir,
Karuna?
we need to wind up. We need to wind up in 5 to 10 minutes.
So, should I continue with the presentation, or you will take up certain some questions from them? How you suggest?
Questions I'm almost taking
Okay,
simultaneously.
done,
If you
done, done.
want to
So I'm
complete this
continuing.
component part, we can take
Yes,
it
yes,
up,
yes.
or we can continue in next session as you
No, no
wish.
problem. No problem. Because these components of internal control, this will take time.
Okay, so
This
let's
will
take
take
it
time.
next session.
Yeah. So rest of the things I will be taking in the next session. So since we have 5 minutes time, if any of you is
Yeah.
having any query, you may please ask. I will try to address that.
Yeah. While testing samples of inventory in case of coal company, we are permitted to take expert decision, right? So expert will act according to management. Can we say it as a complicated task?
Okay,
I
so
think.
this is actually a
Uh-huh.
very good question. So what I understand from his question that he means to ask that that expert will be hired by the management. If he is hired by the management, so basically he will work for the management in itself, right? So what comfort we
Hmm.
will draw from that, right? So
Right. Right.
see again here, if you are able to, based on your experience with the entity, if you are able to place reliance on the management, if you feel that management does not exercise override of controls, management is operating effectively, if you have such feeling and it is being monitored by the uh, people charged with governance properly, so in that case you can ask the organization to appoint an expert. If you don't have that comfort on the management, that you have the feeling that they may uh, basically impact the expert's opinion, so in that case what you can do is you can request the management that expert will be suggested by us, a third party expert will be suggested by us, and you will have to appoint him. So it depends on the judgment of the auditor how they want to go about it.
Dimple is asking practical example or tool we should use to find IC in phase or would be judgmental.
See, now they are since AI has come in now, so agentic AI is also there. So it may aid us. There are a lot of tools in the market now, which can act as an aid for us, which we can use, which we can use for making decisions. But primarily, I'm telling you, maybe big force, because they are having a huge capital with them, so probably they are using those AI tools as of now. But mid-sized firms are yet to use such kind of AI tools for assessing controls. But yes, there are tools in the market, and of late we have seen that a lot of such tools are even offered by the CA Institute also, and even over the counter also few of those tools are available. But it's all about the awareness of the auditor, that what kind of tools which needs to be used for what, and definitely cost perspective is also there. So yes, there are tools, but pre, pre, uh, now we can see that not much of those tools are being used by mid-sized and small firms.
I think now time is indicating us to wind up, and
Okay.
we'll be taking the remaining queries in the next session. And dear students, we are having our next session on 7th February, Saturday. We'll be there with you again 4 to 6 p.m. with the rest of the part, risk assessment and internal control evaluation. Till the time, I request all of you to please refer as a 300 series, because sir is also explaining with the help of that. And of course, you should revise also the concept that types of risk, formulas, and basic fundamentals at least you should come out after reading, so that you can better understand, and practical implication also will be able to analyze in better manner, right? So with this, I thank Roshan sir. You have very nicely explained. In fact, our student wanted to see SOP. You have shown that also. Sir, if any suggestion, any tip from your side till the
Yes.
Saturday, if they should study, you can just share that.
Yeah,
Yeah.
yeah, I'll share that. As rightly said by you, they should definitely go through the standards on auditing, the relevant standards, 315, 320. Those standards they should go through 300 series. And apart from that, what I would say from today's session, whatever query they come across, they should spend some time thinking on it. Whatever queries they are coming up with, no query is a silly query. So it gives you clarity. So please come up with queries. We will definitely address each of your queries in the next class. So please spend some time on it, think on it, and come up with queries.
So, as sir rightly said, and we are also discussing the same, and you may understand that this is very important phase, risk assessment and internal control evaluation, based on the same whole gamut change. So it's very crucial and important for auditor, right? So as sir rightly told, I also wanted to tell you that you need to come out after studying. Of course, if you have not, then sir is already telling you basic, but if you have studied, then you will understand in
Yes.
better manner.
And you will be
Yeah.
able to ask
So with
questions also then.
yes,
Yeah.
yes. And you'll be
So,
able
so
to answer
definitely.
also, because we are having much more. Because it was
Yes.
the first session, so we took basics more. In the next, we will be taking
Yes.
much
Yes.
practical
Exactly.
part. Yeah.
Exactly.
So Samanathan is saying, thank you so much for such a wonderful input to us. So thank you, dear students. Your feedback is very important for us. So please do share your feedback, because it will enable us to improvise further, as this is the first of kind of initiative taken by Board of Studies to give you audit insights, because we observe that students are not getting good marks, and in auditing most of the students are failing. So that is the reason BOS has come out with this initiative. So it's really very important. So your feedback is very, very important. So do share your feedback, because it will help us to improvise. Okay. So with this, we thanks to Roshan sir. Thank you to each and every student who attended. And please come prepared in the next session. Meeting you soon on 7th February. Thank you. Thank you
Thank
to
you
the
so much.
technical
Thank you,
team.
everyone.
Thank you,
Thank you,
BS
friends.
support
Thank
team.
you all.
Thank you.
Thank you.
Thank you all. Thanks.